This is Barry Zalma speaking for Claim School Incorporated's blog, Zalma on Insurance. Today we speak about why a lender must elect to take insurance proceeds in the case of an insurance loss to the property that is the security for his loan. And if a lender approves use of the insurance funds to repair the property, it cannot later claim it was damaged because some summary judgment is just unavailable if there are disputed issues of fact. CG Tides LLC et al., the borrowers, appealed the final summary judgment of foreclosure. Among other things, the judgment at issue allows over $20 million in retroactively calculated default interest on a loan with a principal balance of $41,793,694. The retroactive default interest is based on the finding that the borrower's use of hurricane insurance proceeds to repair hurricane damage to the mortgage property violated the note and therefore constituted a default. In CG Tides versus SHEDDF3 VNB, the Florida Court of Appeals on May 8, 2024, found that there were issues of fact. The foreclosure case involves three main actors. First, CG Tides LLC et al., which are the mortgagors that borrowed the money and granted the mortgage at issue. Two, the original lender, Ocean Bank. Three, SHEDDF3, the note holder, which purchased the note from Ocean Bank and brought the foreclosure action. The trial court granted summary judgment and entered a total foreclosure judgment of $82,169,522, which included principal of $41,793,694, miscellaneous costs, and prejudgment default interest of an additional $40,167,725. No surprise, the borrower appealed. In October of 2014, the borrowers obtained a $45 million loan from Ocean Bank and granted a motion in the Tides Hotel on Miami Beach. To simplify greatly, the note provided for the payment of interest only during the term of the loan and the payment of the entire principal on a set date, unless the parties exercised an option to convert the loan to a more traditional 25-year loan. The parties extended the due date for payment of the principal several times. In September of 2017, the hotel was seriously damaged by Hurricane Irma and was closed for over a year. The mortgage authorized Ocean Bank to direct the hotel's insurance company to pay the insurance proceeds directly to Ocean Bank and provided that Ocean Bank could sign any draft as the borrower's attorney. However, under the note and mortgage, Ocean Bank had the sole reasonable discretion not to use the proceeds to repair, except in certain limited circumstances when the proceeds had to be used to repair the hotel. The borrowers, on the other hand, were obliged to repair the hotel even if the proceeds were not available for that purpose. Despite the mortgage's terms, and although aware of the insurance claim, Ocean Bank never exercised the option to have the insurance proceeds sent directly to it. In November of 2017, the borrowers received $2 million in insurance proceeds, and the borrowers spent at least $7,728,367 in the repair, or more than $5.5 million more than the insurance proceeds. Among other things, the note holder relied on the affidavit of an Ocean Bank vice president, so testifying, and an Ocean Bank emails inquiring about the insurance proceeds. But on the other hand, the borrowers maintained the opposite. Ocean Bank approved a document from the borrowers. A related memorandum in the file regarding construction at the hotel also stated the borrowers intended to use the insurance proceeds to perform renovations in light of damage during Hurricane Irma. Ocean Bank sold the loan to the note holder. The note was sold at par for the principal owed. According to the managing director of the note holder, its business model is to acquire pre-existing non-performing loans so that it can mine the loan histories to exploit opportunities to obtain retroactive default interest. At the summary judgment stage, they in fact obtained more than $40 million in retroactive default interest. So ultimately, the note holder filed a foreclosure action. The borrower's counterclaim for breach of contract and various other remedies, and the note holder obtained the summary judgment. The Court of Appeal found that the borrowers had argued an issue of fact existed whether the borrower's use of the insurance proceeds to repair the hurricane damage breached the loan contract and triggered a default. The borrower claimed Ocean Bank knew and approved of the borrower's use of the insurance proceeds to repair the hurricane damage in the hotel. On one hand, a vice president of Ocean Bank denied this fact under oath. When interpreted in a light most favorable to the non-moving party, other evidence in the summary judgment indicates that Ocean Bank knew of the hurricane damage, knew of the insurance claim, did not exercise its right under the mortgage to direct the insurance company to pay the proceeds solely to itself, received a copy of the borrower's tax return reflecting receipt of the insurance proceeds at issue, verbally approved the use of the proceeds for repair and renovation, and approved this use in writing in its own internal records. The Court of Appeals concluded that the point was, with regard to this motion for summary judgment, that the evidence and inferences therefrom conflict. A fact finder could reach different results depending on what evidence it credited and what reasonable inferences it drew from the evidence credited. Given the state of the record, summary judgment should not have been entered on this issue, and therefore the Court of Appeals concluded that the judgment must be reversed and remanded to the trial court to obtain a finding from a trier of fact, either the court or a jury. In my opinion, summary judgment is not appropriate when there are disputed issues of fact. In most property insurance policies, when there is a mortgage, an insurance policy naming a mortgagee requires payment to both the named insured and the mortgagee. In common practice, the borrower could only use the insurance funds to repair if the mortgagee agreed. There was conflicting evidence because it appears the lender agreed and the new note holder created conflicting evidence and attempted to profit from the hurricane and the monies paid by the hotel owners to repair the building while they foreclosed. The Court of Appeals refused to allow the summary judgment to stand because there were issues of fact remaining to be established by the trier of fact. And maybe they just didn't like the note holder's use of its scheme to profit from the actions of the various parties. This video was adapted from my blog, Zelma on Insurance, which is available free to anyone who clicks on the URL zelma.com/blog. If you do, you can subscribe to the blog and you'll receive notice of every blog posting, usually 5, sometimes 6 a week, and you'll have access to the almost 4,800 blog posts. Please tell your friends and colleagues about this blog and the videos so that they too can subscribe. It's all free. But if you're interested in further detail and information about insurance, insurance claims, insurance law, and insurance fraud, please consider subscribing for a very low fee to my Substack publication. Thank you for your attention.